evening. Welcome to Markets Today. I'm Mkts. With me is Surabhi Upadhyay. It was yet another bad day for the bulls. Actually, the net loss on the Nifty was under 1%, and on the mid-caps it was under 0.5%. But the importance of today's loss is that Europe was not losing. When we were beginning to break down in the second half of trading in the post-noon session, Europe was actually trading in the green, and so were the Dow futures. So this seemed to be more specific to India. The accumulation of positions in the futures in the F&O market is again a little eerie. People seeming to be buying too much protection in the fears that there could be more selling. So quite clearly, even long-only investors or foreign investors are watching the Indian markets with trepidation, with fear, ahead of the FOMC meeting. And you can see that particularly in the way bank stocks were selling off. Well, more on that later on in the show. Hi, Sue.
Hi, Lata. Yes, what a day for bulls. I mean, now we're looking at levels of around 7,700 on the index. It's a far cry from a trading range of 8,400 to 8,600 that we used to talk about. Well, lots coming up on the show. Let's get started with the headlines. Another weekday on Dalal Street as the market gives into selling pressure in the second half of the day. The Nifty nears 7,700, closing at the day's low with a 1% cut. The Sensex slips below the 25,500 mark. Bank stocks lead the decline with the Bank Nifty falling 1.7% and the PSU Banking Index sliding 3%.
The Midcap Index closes 0.4% lower, faring relatively better than the benchmark indices. Sugar stocks like Bajaj Hindustan and Berhampur Chini gallop between 6 and 9% as the UP government announces a 2,000 crore rupee package for the sugar sector. Oil and gas stocks support the gain, and stocks like Celan Exploration, Shivwani Oil and Jindal Drilling surge 7 to 20% on news that the government's exploration policy will be supportive for these smaller companies.
And more details on that policy. India junks the cost recovery formula and adopts a new revenue share model to boost oil and gas exploration in the country. The move is in line with recommendations made by Dr. C. Rangarajan and will be initiated by inviting bids for 69 marginal oil and gas fields.
Auto majors pin their hopes on the festive season at Siam'S 55th annual convention, that is the automobile makers' body. Honda Motor says full-year growth will be just 3 to 4%. TVS Motors feels that 2016 will be a better year, the calendar 2016, and Maruti strikes an optimistic note, saying sales will pick up significantly over the next few months. And those were some of the headlines that dominated the markets. Here are the experts that we have lined up on the show for you. Ajay Srivastava of Dimensions Consulting and Nilesh Shah of Kotak Mahindra Mutual Fund will be joining in with their take on the markets. We will also get you the managements of automobile companies from the sidelines of the annual Siam convention, the Society for Indian Automobile Manufacturers. They'll be talking to us literally about the road ahead.
So let's tell you what exactly happened today. There's simply no respite on Dalal Street. Bears launched yet another late onslaught to take the market to its lowest level in over a year. Sonia is now joining in with a wrap of the day's trading highlights. Sonia, bears in absolute control?
Oh, yes, they are. And you know what? This market has become technically extremely weak. So one would have thought that you could see some amount of rebound after, a fall that we saw in the last 2 to 3 days. But no, none of that has actually come about. So the Sensex and the Nifty have ended at about 13-month closing lows. The Nifty, in fact, slipped below the 7,700 mark intraday. And the Bank Nifty was the biggest disappointment today. The Bank Nifty cracked in trade and is now in a bear market of its own. The Bank Nifty down about 22% from the 2015 highs. Also, apart from the banks, the auto sector has been quite weak because of the weak August sales. So there was a pressure seen across all rate sensitives today. Now, we saw that the cash market volumes were quite high, more than 18,000 crores. And the buzz is that there was one large basket selling order of 300 crores by FIIs. So I won't be surprised to see another sell figure come in, a big sell figure come in from FIIs tomorrow. Also, we've had more and more brokerages go ahead and cut their Sensex targets because of the global situation. CLSA was the latest one in that list. It cut its Sensex target by 6%. to 30,000 by December 2016. But let me take you through the stocks that got hit hard today. The biggest losers were the banks, undoubtedly. So you had PNB, SBI, Axis Bank, ICICI Bank that were all down anywhere between 2 to 4%. In fact, ICICI Bank is now down 25% this year and is sitting at a fresh 52-week low. Apart from that, autos like M&M, Bajaj Auto, Hero MotoCorp and Tata Motors all reported weak to lackluster numbers this month. And all of them were down anywhere between 1 to about 2%. In the oil and gas space as well, you had ONGC, KN and BPCL that were under pressure. Capital goods like BHEL and L&T were under pressure. So as you can see, it was a secular run on the downside that we saw. But which were the stocks that saw some respite? There was technology that led some support to the market. So you had Tech Mahindra, TCS and Infosys that were not too bad. Cement stocks did well. So Ultratech, ACC and Ambuja bucked the trend today, all of them up about 1%. But the mid-cap space had a very interesting trend. A lot of the non-index large caps, the ones that have given big returns this year, came in for profit-taking today. So there's LIC Housing Finance, Glenmark Pharma, Titan, HPCL, Union Bank. All of these stocks were down anywhere between 5 to 6%. But on the gaining end, we did have some favor back in the pharma space. Dishman Pharma was a big mover. Sun PV surged in late trade. And one theme that stood out today was the mid-cap FMCG names. So Imami and Dabur were stocks that did quite well. But all in all, another weak day, and the market has been moving only one way, and that's southwards. Back to you.
Thanks a lot for that, Sonia. Just a word more on the way the banking stocks got sold off, especially the PSU banks. There has been a string of challenges for these stocks. I mean, post-facto analysis is always easy. But the last straw on the camel's back, or the latest straw, if you please, was the Reserve Bank of India saying yesterday that it's announcing draft rules on how they have to calculate their lending rate. And that lending rate, or what you call base rate, will depend on the marginal cost of money, or the cost of money in the just preceding month. So if you have cut your deposit rates in the month of August, then your lending rate has to fall in September. The fact that over the last 1 year, your cost of money was much more expensive, and that only 1 month you cut the rate is not going to be argument enough. Until now, banks were cutting their lending costs after the entire deposit basket was repriced. That is, the average cost of money fell. But after April, they have been told that the moment the first deposit rate comes, it has to get passed on to the lenders, to the borrowers as well. That is, the lending rate cuts have to come. This is still draft rules. It will become a law only after April. And I can trust banks to find several nimble ways to sidestep by cutting deposits in non-important buckets, by creating 2 or 3 important buckets, 1 year, 400 days, 300 days. There are ways to sidestep these rules, and we know that banks are past masters. But at the moment, they're already gone through a lot of negativity. So that's why you have all these brokerages saying that PSU banks are going to struggle because of this rule. 2 days back, HDFC Bank cut rates savagely, lending rates. That's going to be an added competition. And for me, that is even more severe for the public sector banks than the RBI rule, which will kick in 7-8 months from now. As well, the GDP numbers, could have put some question marks on growth, though I still believe the GDP numbers were not all that bad. But that also created some doubts about growth. And as commodity prices fall, then again your steel borrowers are likely to renege on their repayments. So there is enough bad news. There is money that long-only investors have made in public sector banks. If you look at year-on-year levels, they are still in the money. So it's a good place that they will take to sell, because they don't see any future for the next 6 months or so. And that's why the selling came. I'm worried about the selling because it was not accompanied by a pan-Asian selling or a pan-European selling or a global selling. They were picked out to be hit, which is a bit worrisome.
And the second day running, might I add, after a savage fall yesterday, it just continued today as well. Well, that was banks under severe stress, but now let's get you some opinion. The volatility in the market over the last few days has left everybody guessing as to what the market will do next. Ajay Srivastava, CEO of Dimensions Consulting, says that it's perhaps best right now to stay with cash.
We have not added into a position for the last 4-5 days, to be honest. And to be fair to everybody, I just don't understand what's happening to this whole thing. I think I just need to settle down. It's very easy to walk in and say it's a great bargain. But am I convincingly buying the share when I pick up or advise my customers? My answer is no. So I think we are all waiting to see what this whole thing plays out. And to be very honest, now it's reaching a point where I may go into analysis paralysis, but I just can't understand the next move of the market. I think cash is going to be at a premium for the next 6 months or so on the retail market. A lot of it is deployed, unfortunately.
Oh, some candid thoughts there. Well, the big story this evening, a landmark change to India's hydrocarbon exploration regime. The Union Cabinet approved a new simplified revenue sharing model to replace the current production sharing contracts, or PSCs as they are known. Nayanthara Rai explained the details to us a little while ago. Let's hear her out.
The big headline from today's cabinet decision is India has decided to do away with the cumbersome cost recovery model for production sharing contracts and switch to a much more simplified one to do with revenue sharing. The cost recovery model was a cumbersome one. It had resulted in the CAG, the oil ministry, nitpicking, asking companies why did they decide to go with one rig company and not with the other, because the government felt if a company doesn't keep its costs low, it would come at the cost of the exchequer. The revenue sharing model, as first mooted by Dr. C. Rangarajan when he was the chairman of the Prime Minister's Economic Advisory Council, is more simple. What it says is the government is going to get a percentage, a share of the revenues that will be made by the company, and therefore that model is based on the premise a company is going to keep its costs low and increase its revenues. The hope is that once India adopts this model, we are going to see private sector being enthused to enter exploration in India. At first, the government is going to do this with a competitive bidding process for 69 oil and gas blocks, which are marginal fields. These are 69 marginal fields that had failed to enthuse the private sector. Most of them had belonged to ONGC and Oil India. They'd been given up. A quick editorial comment over here, and what experts are also saying. At a time when crude price is so volatile and they have crashed to levels that they have, it is difficult to believe that global players or even private companies are going to take the high risk of exploring these marginal fields. They may want to do so with more safer ones, but the government hoping that if rig prices are low, crude prices are low, companies will feel, let's invest now and capitalize and make money 3 to 4 years from now when production is going to begin. But like I said, it's difficult to believe that. For example, you look at BHP Billiton. In the last quarter, its net profit fell by 86%. Is it going to take the risk of coming to India to develop marginal fields? The bigger headline is, like I said, India switching to a new revenue sharing model, and one when it brings out the next NELP round. Will it bring on the likes of BHP Billiton, Rio Tinto, ExxonMobil, BP, the likes of all of these companies coming in to bid for such oil and gas blocks?
All right, Nayanthara, thank you so much for that. And that move really fired up a lot of the support service stocks. Your Jindal Drilling, your offshore company, Ceylon Exploration, they were all going through the roof. Well, the government's decision to allow the explorer to sell gas at market prices has definitely got a thumbs up from the industry, with the chairman and MD of ONGC, D.K. Saraf, telling CNBC TV 18 that the upstream major will indeed be interested in developing some of these marginal fields, which it had given up on earlier.
Market price of gas is expected to be low, but in any case, they are going to be higher than the government-determined price. So that could be attractive even for today. In addition, the prices of crude oil and hence of natural gas are expected to rise maybe a couple of quarters or after a year or two, and when that happens, these fields will become even more viable.
All right, some enthusiasm for the new government policy. Well, this is a story you first heard on CNBC TV 18, and now the company confirms it. Realty major DLF rose quite a bit today in trade after it announced early morning that the company has entered into a joint venture agreement with the Singapore government's Sovereign Wealth Fund, GIC, for 2 projects in Delhi. GIC will be investing a total of 1990 crores for the 2 projects, which will be developed under the DLF Home Developers brand. And then, of course, we spoke to the executive director of DLF, executive ED Finance, actually, Saurabh Chawla, and he says that they hope to launch this project by the middle of next year.
It's a joint venture to develop 2 residential projects in central Delhi. These are in the same neighborhood as our current project of Capital Greens. And, GIC is one of the largest sovereign funds in the world, and they have aligned with us to develop these projects. We will be applying for approvals over here. These projects will get launched sometime mid of next year. So these are very early stages of planning and development.
Moving on to some sector-specific action. It's been a tough couple of years for the entire Indian auto industry, but things could be turning for the better if the mood at the 55th annual SIAM convention is anything to go by, with almost all the automakers of the country being cautiously optimistic that industry as a whole could be on the path to recovery. But it won't be without its share of speed bumps. Now, an erratic and below-par monsoon, a string of policy changes, and the global macro gloom and doom environment could be potential party poopers, which in turn means that the industry is predicting a full recovery only by the end of next year. CNBC TV 18 spoke with a whole host of auto manufacturers and component manufacturers to gauge their mood about the upcoming festive season.
Well, we are starting from a very low base. So just to say the worst is over, or is it a pent-up demand, it's hard to tell. But, I think it's more than a pent-up demand, because you're seeing it consistently every month. I think when we see the two-wheelers really start growing, I think it'll be real growth by that time. Also, the change in government resulted in a change of how rural entities and incentives were delivered. I think that has also made a change in the demand pattern of two-wheelers.
In India, just starting at the festival season, that is the booming season for the industry. We are expecting as August, September, October, November becomes big months for our industry. Yeah, of course, we are targeting the increasing the growth of the sales. Otherwise, we have no meaning to continue the business. But also, market should be growing. Total market should be growing. That's why we have to grow our volume, of course.
The M&HCV growth is dependent on the fact that fleet replacement, which got postponed considerably for 2 to 3 years, is coming back. There are emissions kicking in, regulations kicking in, which means there is a bit of pre-buying sentiment. So I think at least for the next 2-3 quarters that will continue, though recovery of the GDP and the underlying economy, particularly manufacturing and mining, will put the growth on a stronger track.
Starting this month, we will start once again stocking up for the festive season. While on the festive season, in spite of whatever the environment is, whatever the monsoons are, we are very hopeful, we are bullish about the festive season. We are looking forward to the festive season, and like every year where we've done really huge numbers during the festive season, likewise in this year also, we expect to do very well. The segment which is growing faster, the scooters, we are about to launch 2 new models.
All right. You will get to hear more from the Society of Indian Automobile Manufacturers convention, a lot more big voices through the day. Let's now turn our attention to the global markets. The markets in China managed to recuperate from early loss and ended only 0.2% lower. The Shanghai Composite had initially tumbled over 4% at the start of trade, but China is imposing fresh controls to prevent too much money from leaving its shores. The country's central bank said that it will make it more expensive for investors to pressure the yuan to weaken against the US dollar. Net-net, the markets didn't end with too much by way of losses. Well, we'll take a break on that note, but coming up, Sudarshan Sukhani will join in to gauge how tomorrow might pan out for the Nifty and for some stocks. We'll, of course, get you more market opinion as well. Nilesh Shah of Kotak Mahindra Mutual Fund spoke to us.